Today we're going to be talking about Tesla, as the stock has ran up over 40% in the last month. And this move up isn't showing any signs of slowing down, as the company announced better than expected Q2 deliveries. However, even with these results, there are still bears out there calling for the stock to fall all the way down to $15 per share. So in this video, we will take a look at those delivery results as well as the bear case around Tesla. So if you enjoy, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. As I mentioned in the intro, Tesla stock is up 41% so far this month. But if we look over the last 6 months, it gets even better. Tesla hit a low of $142 in April. From there, the stock has ran up 77% in just a matter of a couple months. In the last year, the stock is still down almost 10%. And from its all-time highs that were achieved back in 2021, the stock is down almost 40%. Tesla's most recent move up comes on the back of their deliveries announcement. They put up just under 444,000 deliveries for the second quarter in 2024. Analysts were expecting them to put up closer to 439,000 deliveries, so they beat analyst expectations by around 4,000 vehicles. And overall, a beat of 4,000 vehicles is nothing super impressive. However, what it does is it stops the bleeding. Last quarter, they put up 386,000 deliveries, which was very much below the numbers that we have seen over the course of the last couple of years. So for them to get back above this 400,000 delivery mark is going to be good for investors and instill a little bit more confidence in what Tesla is doing and that they are not going to keep falling in terms of their delivery numbers. So overall, there is a little bit of good in this number as well as a little bit of bad. The good is that quarter over quarter, they're getting back to growth in terms of their delivery numbers. However, year over year, this is still a decline from the numbers that they put up a year ago of 466,000 deliveries. And for some portfolio managers, these drops in deliveries year over year are very concerning for Tesla. This specific portfolio manager has a price target for Tesla of $15 per share. And this portfolio manager is known as Per Lakander. He is the manager of the clean energy transition, and he is stated saying Tesla is the biggest stock market bubble in world history. The models are aged, the valuation is absolutely insane, and earnings are falling off a cliff. Here we have Per Lakander talking about Tesla back in April of this year.
I disagree with this. Earnings are coming down very, very quickly. I totally agree with the description, unmitigated disaster. I think he meant really bad quarter. What I think here is that this was really the beginning of the end of the Tesla bubble, which probably arguably was the biggest stock market bubble in modern history. I actually think the company could go bust. And because
You think Tesla could go bust?
Yes, because you have to explain that, I have to reverse. What was the Tesla business model? 3 elements. Number one, for 10 years, they've said 50% annual revenue growth. That has been valid up to January. Second, integrate vertically, so you capture all the value from the car sales. Third, direct sales, no value to any retailer, etc. That's a brilliant model when you grow, because you have negative working capital, so you actually get paid for growing, and you capture all the margin. The problem is when you go in the reverse and sales go down, it also goes in reverse. You have all the fixed costs, which you have to spread on a smaller volume. And you also have the fact of that you have your negative working capital unwinding. So I think that the real shocker for the market here is going to be the actual numbers, which come in 2.5 weeks' time, because the market is thinking 2 billion positive cash flow. It's going to be minus 2 billion cash flow on my numbers. Next thing, I think most of the knives, etc., are believing that this was a bit of a one-off, and relating to what you said about arson attack or whatever. Let's face it. How does record high inventories go together with production problem? This is a demand problem. And it's a demand problem for a very simple reason. They are really selling 2 cars. Model 3 introduced 2017. Model Y introduced 2020. This year alone, Volkswagen, as an example, is introducing 30 new cars, the majority of them being EVs. Competition is heating up. They have no new car until they say end of 2025, but more likely it's like 26. So what I'm saying here is that you had 9%, 8.5% year on year down on number of cars sold, and 20% quarter on quarter. I don't see any reason whatsoever to see any recovery over the next 2 years, given that these models are stale and given the economy is not rocketing. And so if you take, I'm having on quarter next, in 2 weeks' time, I have around 30 cents of earnings. Sure. Do that times 4, you are at 140. On a no-growth stocks, you should be at 10 times earnings. 10 times 140 means $14. That's probably a fair valuation. I think, however, Tesla cannot be at $14 if it falls under a certain level, because everything which been going on is going to go bust. You know, you have so many cases of the lawsuits, class action. You know, either it's full safe driving, either it's the board, etc. So I don't know where that level is, but let's say it falls below 50. All that it can't play out.
So let's step back and go over a few of his points. First off, this interview was before their last quarter of earnings, so they actually came through and reported 45 cents of EPS versus what he was predicting in that video of 30 cents of EPS. So he is very bearish on this company and does have a pessimistic view of Tesla and where it's headed in the future. A couple things that I do think he gets right is there is competition coming into the market. That competition tends to be lagging behind Tesla and their technology. So I don't necessarily think it's as big of a competitive threat so far for Tesla, but there is some sort of threat there for their margins. And that is something that investors will be paying close attention to in their next earnings report. However, it does look like this could be a one-off quarter. Because again, last quarter, this is when we saw the report that the deliveries were coming in lower than expected. And now in the second quarter, we're seeing those delivery numbers recover, which overall is a positive thing for Tesla shareholders. However, if we do see a sustained decrease in their deliveries, this could feed into what he was getting at in that video, where Tesla incurs a lot of fixed costs. Where the company is growing, they can get better margins because of all these ways that they are building out their ecosystem. However, if we see their business decline and their deliveries slowly decline, that could actually hurt a lot of their numbers because they have all these costs that they're incurring because they want to be very vertically integrated. One of the more interesting topics that I think he brings up is Tesla's valuation. He has them valued at a 10 forward P ratio, which has the stock dropping in a very significant way. And we'll take a look at that valuation here in a second, but it's really based off of growth. And if we look back in the third quarter of 2022, they put up around $21.4 billion of revenue. In the most recent quarter, they put up $21.3 billion of revenue. So their growth in the last year and a half has been very, very flat. However, before that, they saw very significant growth. In 2020, they were putting up $6 billion of revenue. And again, by 2022, that grew all the way to $21.4 billion of revenue in a single quarter. And if we look at their EPS numbers and we go back to 2022, we can see that they put up $1.07 of positive EPS. However, in their most recent quarter, that has declined all the way down to 34 cents of positive GAAP EPS. And what Per Lekander is trying to do with this valuation is he's trying to compare it to other motor companies like Ford. We can see that Ford right now has a trailing PE ratio of a 13.24 and a forward PE ratio of a 6.2. When we look at Ford's revenue, it's been very up and down on a trailing 12-month basis. When we look at their quarterly basis, they brought in $42.7 billion in the most recent quarter. If we go all the way back to 2018, they brought in just under $42 billion. So very flat in terms of their revenue just over time. And Ford's EPS numbers are even worse. They are just all over the place. We could see the most recent quarter, they put up 33 cents of positive EPS. They have had quarters as low as minus 78 cents, as well as some quarters as high as 81 cents. They're just all over the place and not seeing a consistent trend from any of their numbers. And that's why their valuation is sitting so low. Tesla at least has some resemblance of an upwards trend on all of their numbers. Again, here's their EPS and then here's their revenue, both showing uptrends. When we compare that to Ford, these are two very, very different companies. And because of these differences, Tesla commands a higher valuation. Their trailing PE ratio is sitting at a 64.33 and their forward PE ratio is sitting at a 101.01. And the way Perlicandor is getting his price target of $15 per share is by assuming that the PE ratio would drop all the way down to this 10 number from the 101 that it's currently sitting at. If we do that ratio, we actually get a price target of $24.85. This would be a 90% drop in the stock price. If we assume a PE ratio of 15, that would actually be a price target of $37, which would be an 85% drop in the stock price. So personally, I think that Perlicandor is a little bit off in terms of his valuation. A 10 forward PE ratio for a company like Tesla is insanely low, especially because their metrics are trending in the right direction. However, the valuation that the market is currently putting on Tesla, in my opinion, is a little bit high. I think that they should be valued at a PE ratio anywhere between a 50 to 60 in terms of their forward PE. Right now, I think the market is valuing it up at 100 just because they're expecting earnings to rise over the course of the next year, and then that'll help drop down this valuation. But right now, I think that that's a little bit up in the air. We need to see how numbers come out. And Tesla is expected to announce those numbers on July 23rd. They are expecting an EPS number of 60 cents per share and a revenue of $24.18 billion. So personally, I do not own any shares of Tesla. However, when I hear this news that they are coming through with positive numbers in terms of their deliveries, that I think is a good thing for the broader market. It tells us that consumers are out there, they're willing to make these bigger purchases on cars, which in general means that there's a little bit more consumer confidence in the broader market, which will have a good impact as a lot of these companies are set to announce their earnings here at the end of July and early August. So that for me is my biggest takeaway from this. But keep in mind, do not buy a company just because I talked about it here on YouTube. Don't buy a company just because an analyst or a hedge fund manager talks about it. Make sure you are doing your own research, looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, how does a penguin build its house? Check the comments down below for the answer. Thanks for watching.